Welcome. This is Tax Pro Nation, the home of the independent tax professionals, where you can find a tax community, maximize your earnings, and live life on your own terms. I'm your host, Imelda Ledesma, COO of Pronto Tax School. So we've been a bit MIA lately. We've been busy hosting our third live event in Long Beach, California, which, by the way, we had such a great time and enjoy spending time with all of you that joined us. Then after that, you know how it is. Life happened. Some of us got sick and things got a little hectic. But we're excited to be back. And in this episode, Andy and Andrea will lead the conversation on the exciting world of damage control strategies for Schedule C. Start by letting your client know about the discrepancy you've identified in their prior year return.
So can I ask a question, Andrea, while we wait?
Yes,
Go for it.
of course.
Okay, so I have a new client who converted this year to an escort from a sole prop. They had an EIN because they had employees, 3 employees. Okay. And when I was talking to her yesterday, she told me that she brought all her payroll from Q1, which was reported under the sole prop EIN, into Pasto, and that they are going to issue one W-2 under the new EIN. But Q1 is going to be reported with the old EIN, the payroll, the 941s, and then the other 3 quarters under the new. But it seems to me that there should be 2 W-2s, one with the old EIN and one with the new. She shouldn't have brought into Gusto old payroll for them to issue just one W-2. It just doesn't make sense to me. But she was told that Gusto told her that's how it's done.
So I think so she had to get why did she get a new, she had to get a new EIN because the entity type changed, right? Sole prop
incorporated,
S Corp. Yeah. Right. So she had to form an LLC or incorporate and then make the S election.
Exactly.
So yeah, it should not be. My guess is that she told Gusto something incorrect because that first quarter, if the EIN had stayed the same, then it would all come over. But because it's a new EIN, it's a whole new entity, it's whole new bank accounts, whole new books, whole new everything.
Yeah.
It should be separate. So she's probably going to want to reach back out to Gusto.
That's what I told her. So I am going to call her back today. It's like, let me check with my power source and I will get back to you.
Yeah. That's because it's a separate EIN. It should be 2 separate W-2s.
Yeah, it's like, it doesn't make sense to me that you would report the same under the new EIN, all of it. Thank you.
Yeah, no. Yep. Because even the S election can't be effective back to January 1st this year because the LLC did not exist at January 1st this year. So if she'd already been operating as an LLC and then just made the S election effective back to the beginning of the year, no big deal. But it's a new entity, so say she formed it on, April 1st, the earliest her S election can be effective is April 1st. So yeah.
That's what I thought.
You're right. Interesting. My guess is because Gusto's pretty good at what they do, but it's garbage in, garbage out, right? So if they're not getting the correct information, they're not going to be able to give the correct answer.
Yeah, that's what I'm like. I don't know why would Gusto mix and brought all the... Like I just recently did that for a client, but the EIA didn't change. They just changed payroll providers.
Right. In that case, yeah, it would come over.
Yeah. So we brought all the transactions. We entered all the information from the first of the year through March 31st, right, into QuickBooks payroll. She's using QuickBooks payroll now, and we check everything. But in this case, I thought that's not supposed to be.
Yep. My guess is she told them the wrong thing.
What is the nature of your engagement with this client, Marley, in the sense of like, are you responsible for this? Are you perceived as responsible for it? Or how do you price it?
Doing their books now that they are an S corp, now that they incorporated and are an S corp, they want to, have real books.
Yep.
And
I love that.
She's actually a referral from one of my existing clients. And so she wants to start, in everything good from the get-go with the corporation, except the fact that she now has to her payroll.
Yeah.
Okay,
Yeah.
well, I want, because it's like, that's just supposed to know and guide you on this, but maybe I really don't know what she told them that I am, right? I'm sure she told them, look, we got a new EIN, and no, she actually changed payroll provider. She was with ADP and she's now with Gusto. So maybe she did not explain properly to them that she had changed entity types and she has a new EIN number.
So do you
That's what I'm
do you
thinking.
charge like a setup fee for that type of client, or how do you business wise, how do you handle that, or is it included in the monthly that you pick up?
Hi, Andy. That's a good question.
Because that's really common, right? I mean, it's always going to be, that kind of issue or something going on where it's going to be something that's extra, so it might be worth kind of looking at how the expectation matches with the income or how that goes. But that's just a humble suggestion. It sounds like a good client though. So do you find, Marley, that and other people, that when people move to an S corp, that's when they are more interested in having more official books and, paying a bookkeeper and paying a monthly amount? Think that's something you see?
I believe so. Once they know that they have to file a separate tax returns for the entity, and that there are penalties for not filing on time for each K1 and things like that, they take it more seriously, and especially because now they know that they have to be on payroll themselves. So they take bookkeeping more seriously, and they are willing to invest in. But to be honest with you, what I try to do and encourage them is I like them when they do their books and engage into their books. It makes them better business owners.
Yep.
So I'm always tell them I will be more than happy to do QuickBooks coaching for you, teach you how to use it so you do the everyday operations, and I just do maybe quarterly reconciliations. So that's what I am trying to, how I try to handle this. They come to me to set their books, and then I teach them and let them go, and then just meet with them periodically.
Nice. Yeah, interesting. Okay. Well, that's I think that's a good option to have for people and for clients. So we wanted to let's go ahead and start with the session, as I know everybody's showing up expecting a certain topic. We're going to check into, guys, why the link didn't go out on time. So sorry about that, but hopefully everybody knows that you have access to the recordings always, as well as all the notes in your account. So we're talking about Schedule C damage control strategies. Whether it's Schedule C, S corporation, any business clients, I think that there's always going to be a certain damage control element. I think that's something that we've all seen by this point. I wanted to start the conversation here with talking about damage, like whether we call it potential damage or it's like damage that's already happened but hasn't actually been brought out by IRS, because I think this is probably the majority of things, right? Like you have a large majority, I think, of Schedule C clients that are one way or another not quite in compliance with what the IRS wants them to do, but the IRS audit rate, has been quite low. So I want to just talk about a few issues where you may be seeing clients now that you can see that they have an issue from a prior year, for example, and just quickly, like how do we handle that? So one thing that we would see potentially is unreported income from a prior year. So what do you think, Andrea, is the process for you discover that with a new client, let's say? What are like the action steps to address that?
I'm going to have to apologize. There's a little bit of background noise because the train just decided to go by. So sorry for a few minutes. It might be a little loud. So the first thing, if I did not prepare the return, right? So my answer is going to be different if I prepared the prior year return. Well, it really isn't. Either way, whether I prepare the return or not, the first thing that I have to do is I have to let the client know that I found a discrepancy, right? We have an obligation to our clients to tell them that we've identified an issue with their prior year return, whether it was their fault, they forgot to give us a form, we forgot to enter a form, whatever the reason. If we find a problem, we have to let the client know. From that point, and if you can, you should let the client know what the repercussions are of not fixing that problem, right? So we've identified this problem. You've underreported your income. That means X, Y, and Z could happen. At that point, it's really up to the client whether they want to amend the returns or not. We can't force them to amend. It's really up to the client. So our obligation as tax professionals under Circular 230 is to let them know about the issue, let them know the potential repercussions, and then leave it to the client to decide whether they want to amend or not.
And for liability or protection idea, are you thinking that that's done? These things are done best in writing, or is a verbal discussion, you think, sufficient?
I love that question. I am a big CYA person, especially now that I'm licensed. I generally like to deliver bad news in a live meeting. I mean, I would rather deliver it in writing, but I feel like it's better delivered in a live meeting. And when I say live, it could be virtual, but an actual live meeting with a client. But then I will recap in writing to make sure they understand what I said in that meeting. Because sometimes, people hear, oh my gosh, I'm going to owe an extra whatever in tax, and they tune out the rest of the conversation. So I do generally follow up with an email.
And is so I'm thinking that exaggerated deductions would kind of follow the similar process. You think there's any difference in that process?
Definitely got to let the client know, again, tell them the repercussions. I've heard from a lot of tax professionals who say, and we see this a lot in social media posts, that if you identify these issues to the client and they refuse to correct, that's a red flag and you should walk away. I don't necessarily agree with that. I will say that how the client reacts to the news that you're delivering could be an indicator of future behavior, right? Like if you tell them that you reviewed their tax return and you find a bunch of wildly inaccurate expenses deducted on the return, and if their response is, yeah, I know, my chances of getting audited are none, so I'm just going to keep on keeping on, that's a red flag for me. That might be somebody I don't want to work with going forward. But if they're like, oh man, I mean, I just really didn't understand, or I didn't know, or I don't know how that happened, or I thought I could write that off and my tax person didn't tell me I couldn't. For me, that's not a red flag. Then that's an opportunity to educate that client and to do it right going forward. Most people, I think, maybe I'm generalizing, but most people don't want to commit fraud on their tax returns, right? Most people don't want to commit tax fraud. Some people do, but most people would prefer to get it right and stay off the IRS's radar. And so I'm willing to help those people correct. And if they don't want to correct the inaccurate tax return, as long as their intent is good, I'm willing to help them do it right now and forward.
Yeah, makes sense. So each tax pro might have a little different policy of that, depending how you want to run your business, or what kind of clients you want to work with. So we had talked in I think it was the Monday session about, if God forbid you get into an audit situation with a client, if the client has some kind of bookkeeping set up and they have a separate business account and or business credit card, as opposed to commingling all their personal expenses, just having those two things is absolutely huge in terms of when we talk about damage control, right? It's like, what are going to be the main controllers of the damage? And these were determined to basically be it. So I think a lot of people think that it's going to be having all the receipts and these types of things, but it's really not. It's really these two things, having some kind of bookkeeping attempt, and then having separate bank account and credit card. So let's say you identify that a client, they don't have either of these things, right? There's a lot of experimentation that has gone on that you guys the members have probably tried too, of where trying to get bank statement data, trying to do that after the fact, and how to do that efficiently without it becoming a giant nightmare. Can you talk for a second about the whole bank statement conversion to Excel, or the fact that you've done no bookkeeping? So that's a lot of Schedule C clients. That's their situation. You've done no bookkeeping.
Right.
That's not ideal for not only for now and moving forward, but for the past, right? For this exposure element. What is your method or methods for using the bank statements to efficiently and in a low cost way get some attempt at bookkeeping? Is that feasible? Does it work well? What kind of systems do you recommend? That kind of thing.
Yeah, so there's a few options. If you're not interested in doing any kind of after the fact bookkeeping with accounting software, you can use Excel. If you have PDFs of the statements, you can use some type of PDF converter to convert those to Excel files. You can have the client export all of the data into Excel directly from their bank, which is my preferred method. The whole PDF conversion oftentimes gets some of the text wrong. So when possible, I will ask that client to just export all of the transactions from their bank account into Excel, and then we can do some sorting and try to, filter out, try to quickly identify personal transactions from business transactions.
Is that something that clients can do? Like a normal client, can you tell them like, hey, and there's made like a knowledge base article in the bank's thing or something like, is it something they can do themselves, do you think, or do you need to get user access and all that?
It really depends on the technical savvy of the client, right? I still have some clients who are not good with technology. As our practice changes, we're focusing more on people who are a little more tech savvy because we're implementing technology in our firm. But we do still have a handful of clients who are just not great with any kind of technology. They're generally older, and that's a generalization, but they're generally our older, senior clients. And so in some cases, we do have to kind of handhold through that process. It could be that we hop on a virtual meeting and we walk through how to export that together. Sometimes if it's a bank I'm familiar with, I can send them a quick how-to video, or like an email with the steps for them to follow. So generally, if they don't have any kind of bookkeeping at all, that's going to be my preferred method. I'd rather they export the data into Excel. Well, I personally prefer to use accounting software. QuickBooks Online now has their ledger version, which is $10 per month. So I can connect them to QuickBooks Online at that $10 per month level, import all of the bank data for the previous year, and using rules and other shortcuts, I can pretty quickly get through a whole year's worth of transactions and have a set of financial reports that I can use to prepare the tax returns. One thing that I'm considering doing, and I snagged this from somebody else, so I can't even claim that this idea was mine, but for our clients who don't use accounting software, we are considering requiring them to use a template that we create for them to record their income and expenses for their Schedule C businesses. So it's like, okay, you don't have accounting software, fine. Now you have to put your data into this exact template, and that way our tax prep team is seeing the same format every time, and it'll make the tax prep process smoother. So we're developing a template for our Schedule C clients, and we're developing a template for our rental property clients. And again, that way it just gets more efficient for our tax team because they'll be seeing the data presented the same way every time.
Yeah, that's what we currently do. That works really well for clients.
Yeah.
Okay, so would you say by far preferred method is to connect an accounting software, specifically QuickBooks Ledger, $10 a month? But how far back does it go? Could it pull in transactions from, 18 months ago, or how far back does it go? Do you know?
So that depends on the bank. Some banks limit it to 6 months, some limit it to 3 months, some you can import back to the creation of time. Okay. So it's going to depend on the bank, and that might affect my decision.
Yeah, gotcha.
Generally, if it's a bank that I can at least import the whole prior year, my preference is going to be QuickBooks. I'm an accountant who is not great with pivot tables and VLOOKUPs and all those Excel tools. I know, don't shoot me, like everyone thinks CPAs are like wizards in Excel. Well, I didn't come up that traditional CPA route. I just went straight to the software. So, one of the accountants in my firm is a whiz in Excel. He could probably take that Excel data and a couple of keystrokes, have this beautiful pivot table that lays out a P&L. But for me, I'm going to be faster in QuickBooks. So some of it is just a practice level decision. Some of it is a personal, which employee is doing the work. That might affect our approach.
Yeah, makes sense. So for those of us that are kind of like, looking at this damage control conversation as I feel like the IRS there's going to be increased issues from non-compliance beyond what's been going on now. So if that's your general like thesis, I think this initial part of the conversation is like, how can you approach it for things that have already been done that, you know, it's the past, right? But how can you provide a little bit of a kind of like pre-damage control if you wanted to, in an efficient way for yourself that's not going to suck you into, too much of unpaid work and out of scope work and things like that. So hopefully, and I think you guys all have your own sort of, viewpoints on this, but hopefully that general conversation is helpful, because I think a lot of us actually believe that it is going to be increasing issues. And so as we get into the conversation about once the damage is already started, one of the main things that happens with the damaging is the opening up of past years. So, that the past isn't quite done with, as they say.
Thank you for joining us. I'm Imelda. Join us next week as we continue to share mini audio clips of the Schedule C tax prep process. If you are interested in listening to the full process and want to be part of the Dream Team community, please visit prontotaxschool.com or email us to support@prontotaxschool.com. Being part of the Dream Team membership comes with getting expert support, top-rated training programs, and weekly video live events. We look forward to having you on board.